Welcome, everybody, to a timely tan version of Burn Your Boat's Wealth. I am flying solo today. I'm Clark Lunt, and today I'm going to hit on something that I feel like has really helped me over the years in investing, and it's probably not what you think. A lot of people have 401ks, right? You get a job, you get a 401k matching plan, and I know that when I met with the 401k investing guy, he basically gave me a choice of aggressive or, not as aggressive. I said, hey, I'm in my 20s at the time, so let's just go very aggressive. If it goes down, it goes down. Not a big deal, because I had full confidence that over the long period of time, it would generally trend upward, right? And so what's ironic about a 401k is that we tend to look at the 401k, and as the market goes up, as it goes down, a lot of times I don't even look at it, right? I just know that I'm not going to touch it until I'm at 67 and a half or whenever I decide to retire, right? And start pulling from it. So whatever the market does, it doesn't really trigger any emotions inside of me, right? It doesn't give me anxiety. It doesn't give me stress, right? Now, if you are 65 years old and listening to this, obviously you're going to have a different feeling if the market, like it has in the past few months, has gone down and significantly declined your ability to retire on the type of money that you thought you were going to get, right? But if you're still in your 50s, your 40s, your 30s, it probably hasn't had much of an impact on you. And ironically, investing in real estate, if you were to take the same exact approach that you do to investing into a 401k, if you were to take that same exact mentality, that same exact approach, you will actually be much better off than trying to use real estate investing as something like you would be buying a stock, right? So when you buy stocks, right, you're probably checking it at least weekly, if not daily, to see where it is. If it goes down, it may trigger you to want to sell, or if it goes up, maybe you want to buy more of it. And that triggers emotional decisions. So we talk about real estate a lot. David and I speak a lot about buying rental properties to being able to build wealth through real estate assets, right? And we call it passive, but as anyone knows, is that once you get into it and you start buying at any kind of significant volume, 5, 10, 15, 20 units, maybe 50 or 100 units, it stops getting not so passive anymore. And you start to get more emotional, right? You have a bad tenant, you have an eviction that takes a long time, you have a roof that needs to be replaced, right? It becomes less passive, more active. And unfortunately, then you start looking at it more like a stock, right? Like, well, if I sell this and I invest it over here, then I'll get a better return. Sometimes that works out, sometimes it actually doesn't. Right? And I want to give you the analogy of the guy or the girl in traffic, right? I will be the first one to tell you that when I'm sitting in traffic, I'm so impatient, right? So I'm looking next to me and it's bumper to bumper traffic. It's 5 o'clock rush hour and I'm changing lanes 68 different times, right? And at the end of the day, I won't get there any faster or slower. Sometimes I'll even get there slower, right? But then there's the other bucket where there's the person that just sits in the one lane. They're not changing in and out. And ironically, they may get to their destination faster than I will. And it's a much less anxious driving experience through rush hour, if that's even possible, right? I give you that example because investing into a 401k is kind of like if you are in your 20s, your 30s, your 40s, your 50s, you just, every month you write a check blindly, whether your 401k is performing well, whether it's performing average or it's not performing as well. You just send in your $500 a month or $1,000 a month or whatever your contribution is, right? Kind of blindly. And ironically, if we were to take that same approach to real estate, okay, that habitual investing into real estate, so where you're not just buying a piece of property and then not thinking about it for 3 or 4 years and then maybe trying to sell it and trade it into something else. If you were to take the approach of the 401k investment strategy, where you just save up, you put money into an asset, you stabilize it, you pay for the repairs out of the cash flow. So it's not really that emotional. It's not that big of a deal. And if you were able to look at real estate like that, if you're able to look at it like a self-directed IRA. So if you're not familiar with what a self-directed IRA is, basically when you take the money that's sitting in your IRA account, right? And instead of investing it into stocks or have like a financial guy invest it for you, all you do is you take control of the investing and you invest it into traditionally like a real estate passive investment. So maybe you invest it into a syndication, maybe you invest it into a turnkey rental property where a property manages it. You just don't have the ability to go in and do the repairs yourself, to manage it yourself. You have to have a third party. So there's still that wall up so that you're not actively participating in the investment, just like you're not actively participating in your 401k. So if we look at real estate like that and we say, okay, I'm going to invest $50,000 into a rental property, okay, for example. And then as the money comes in, right, as the $200 a month cash flow comes into an account, it stays in a business account that I do not touch, right? So let's pretend we still have that wall up like you have on a self-directed IRA. And then it adds up, and then when there's a repair needed and an eviction needs to happen, whatever that may be, you're able to pull money from that account that you haven't touched, right? You're not taking it for income to go buy yourself a new car, take you on a nice vacation. You're keeping that wall up. And then when you take the money from that account, you pay to fix the faucet or fix the AC, whatever it may be, it's not going to trigger much of an emotional response, right? Just like when my 401k goes up or has a bad day in the market, I don't care. I'm not pulling money from it. I'm not taking income. I know that it's just compounding on itself. Okay. So if we were to look at real estate that same way and say, look, I know that real estate's going to go through a roller coaster of ups and downs and sideways, but I know that over say a 10-year trajectory, that it's going to continue to go up in value, that the rents are going to continue to incline over time, that the areas are going to improve around it if you're buying in the right areas. And then I know that as I receive my income from this investment asset, I'm treating it like I would a 401k, where I'm not spending that money on anything that isn't related to improving that property or fixing that property or putting it back into the condition that it was prior to, let's say, a tenant treating it badly. Okay. So I'm not depending on it for cash flow for my own personal benefit. Okay. And I'm also just letting it sit there, right? I'm letting it do its thing. I'm letting real estate do the heavy lifting. Okay. Doesn't that sound a lot like blindly putting money into a 401k every month? And then you get that yearly statement at the end of the year to see how it did, right? It gained 5%, it lost 3%, it did well, it didn't do well. At the end of the day, you know that even if it had a bad year, ultimately it's going to self-correct, and historically it's going to continue to go up and be worth putting your money into. So that is such a great kind of mentality change, okay, that once I started to look at it like I was investing in a 401k, it made me not be very emotionally tied to it. The less emotionally tied we are to it, the more we're going to be able to make reasonable and sound investment decisions, okay? The minute that we start watching all the different news programs and we're watching Mad Money and CNBC and the stocks are this, it's that, real estate market is not doing well or it's doing great, let's buy here. The minute that you cut all that clutter out and you just let the investment do what it's designed to do, which is over time go up. It pays down the principal on your mortgage. It gives you tax benefits. It gives you cash flow. That cash flow is going to sit in a separate bank account, a business account that will then cover expenses in the future. Okay. And then as it builds up to a certain amount, you can choose to be able to take that, still keep it behind the wall, keep it on behind the business wall, and then just invest it into a new real estate investment, which is essentially compounding, right? It's almost like a free investment because you're taking the investment that your money is making, you're now taking that and having it make more money, right? So the reason that I think that that's so important is because most people are watching real estate like it's a stock, okay? And if you play the real estate game like you choose and pick stocks, how is that any different from putting all your money on red at the casino and just hoping you win? That is a very emotional thing. The real estate investing game is a long game, right? It is a marathon, not a sprint, and you have to treat it like a marathon, right? You're not going to get into a marathon and sprint for the first mile and then walk for the next half mile and then jog for 3 miles and then sprint, right? That's not how wealth creation through real estate works, okay? It is a very much a consistent, habitual, continuing to invest month after month, year after year, and not getting tied to any kind of crazy market swings, and just knowing that it will correct itself even in the bad days, and knowing that you get to participate in the exciting times where rents go up, where values go up like we did during the last few years during the COVID times, and knowing that, again, just hold on to the asset, look at it like run it like your 401k, run it like a self-directed IRA. And if you do that, I promise you that you're not going to have the regret. Every real estate investor's number one regret, if you ask them, is I wish I would have kept more and not sold so much, right? Well, if you take this approach of buying via like a 401k investment strategy, you're not going to sell, right? You're going to keep all of your money, all of your winnings, all of your cash flow in a separate account that you don't see, that you don't use when you're going to Disney, and you're there to reinvest it either into that asset or into the next asset. If you take this approach, I promise with all of my heart that you will be much more successful than trying to time the market, than trying to buy the stock when it's at a high, or buy it when it's at a low and sell when it's at a high. Trying to play that game is something that you're not going to win, and let it do what it's supposed to do. So that's all I got for you today. I'm going to hop out. Just know that the long game is the right game, but you need the proper barriers in place to keep you from yourself, to keep you from being emotional about your investments. And I promise you that you will reap the benefits of your diligence and being able to have the willpower to not sell, to not take the income from the property, and only to keep reinvesting. So hope this was helpful, everyone. And as always, we appreciate your feedback, your subscribing, and we're going to continue to keep bringing you some amazing content. So with that, keep on investing, take action, and we'll see you next time. Well, that is a wrap for today, folks. We hope that this episode shed some light on the complexities of the real estate market and kind of really gave you some actionable insights. Because remember, you navigate the world of property investment, it requires more than just luck. You're going to need strategy, you're going to need knowledge, and of course, you're going to need a little dash of courage. And if you enjoyed today's episode, be sure to hit that subscribe button. Leave us a review on any of the podcast platforms that you listen to, and YouTube as well. And don't forget to follow us on Instagram and Facebook at Burn Your Boats Wealth, and leave comments, talk to us about things that you want us to talk about or things you disagree with us on. We appreciate all that type of insight. Your support really fuels our fire to bring you even more valuable content. So we appreciate you. We appreciate the support, and we will see you next time.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.